Assalamu alaikum friends, how are you doing? Hope you are doing good. So today's standard is IFRS 12, very small standard. I think in 5 minutes I'll finish this standard. So IFRS 12 is disclosure of interest in other entities. Okay, this standard comes in group accounting when you're doing consolidation and all. The main standard is of course IFRS 3, but other than that, we have four more standards which is relating to group accounting. One is IFRS 10, where we make consolidated financial statements and all. We define control, where then we define subsidiary and all. Then we have IFRS 11, which is about joint arrangements. IFRS 12, which is disclosure of interest in other entities. Basically, this is a disclosure standard. Okay, what are the things you need to disclose when you're having interest in other entities? Then we have IS 28, which is investments in associates and joint venture. So this video is going to cover only IFRS 12. Each standard is there in different videos. I didn't combine everything in one because the other standards are pretty long enough, except IFRS 12. This is the smaller standard. So IFRS 12 is a single, you will not be asked a question as a standalone question based on IFRS 12, but this question can be asked in group accounting, which is in your question number 1 of SBR. Okay. And this standard, very rarely it comes, it does not come very frequently. Okay. I'm just telling you the frequency does not mean that you don't have to study or leave it. You have to study every part of the syllabus in order to score high marks. Okay, IFRS 12 is a single source of disclosure requirements for business combination. It's not any source of disclosure, only for business combination. If you have bought a subsidiary, if you have bought an associate, if you have in the joint venture, only in these conditions you need to use IFRS 12 to disclose. Okay, this is the only one standard. So what are the disclosure requirements? Now there are 4 disclosure requirements. Disclosure of significant assumptions and judgments made in determining whether an investor has control, joint control, or significant influence over an investee. You need to disclose what were your assumptions and significance, assumptions and judgments that you made in order to decide whether they have a control, joint control. If it's control, then it's a subsidiary. If it's joint control, then it's joint venture. If it's significant influence over an investment, it's an associate. Okay, that is the first disclosure you need to know. Second, disclosure of the nature, extent, and financial effects of his interest in joint arrangements and associate. So when you're disclosing relating to the interest in joint venture and associate, this is specifically for joint venture and associates. Then you need to disclose what is the nature, extent, and the financial effect. Because remember, we don't consolidate associate or joint arrangements. We only consolidate subsidiary. So that's why relating to associate and joint arrangements, we need more disclosure. That's why you have to give the nature and the extent and the financial effect of joint arrangements and associates specifically. Okay, because we're not consolidating them. Third, additional disclosure relating to subsidiaries with non-controlling interest (NCI), joint arrangements and associates that are individually material. Okay. Sometimes if you see that individually the interest is so material that then you need additional disclosure. Okay, subsidies with NCI, joint arrangements or associates. So that additional disclosure could be for anything. It could be for your subsidiaries, it could be for your joint arrangements, it could be for your associate that are individually material. Okay, whenever something is material, okay, in order to remember this point, just think like this. If something is material, that needs to be disclosed. Additional disclosure has to be there for that. Okay, and the fourth one is that there are significant restrictions on the ability of the parent to access and use the assets or to sell the liabilities of a subsidiary. What does it mean? The fourth point, that there are significant restrictions on the ability of the parent to access and use the assets or to sell the liabilities of a subsidiary. That means when you as a parent, you have bought a subsidiary, but you have the restrictions. You cannot use the subsidiary's asset. You cannot uh, pay the liabilities of the subsidiaries once you have acquired the subsidiary. You have some restrictions, and restrictions are very significant. That needs to be disclosed. Why restrictions and all, and what are the restrictions you have? If you have the restrictions, that needs to be disclosed. So that's it for IFRS 12. There are no questions also relating to IFRS 12 as so far. I mean, test your understanding, but definitely in the revision grid we'll go and see whether we have or not. So let me summarize this. There are four disclosure. One is what were your assumptions and judgments that you used to say that it has a control, joint control, or significant influence. Then you need to disclose the nature, extent, and the financial effects of interest in joint venture and associates. This is for joint arrangements and associates only. They didn't mention about subsidiary. Next, additional disclosure. Okay, for subsidiary, associate, and joint venture if individually material. And fourth, if there are significant restrictions on the assets and the liabilities of the subsidiary, that needs to be disclosed. Okay, so these are the four main disclosure. Just remember the four disclosure. That's enough for the standard. Nothing much is there for the standard, right? So see you guys in my next video. Till then, take care.